It always starts the same way. A confident voice on television says, "This time is different. Markets are strong. Jobs look stable. Credit is easy." And then, quietly at first, something breaks. Not everywhere. Not all at once. Just enough. A bank misses payments. A fund freezes withdrawals. A few companies announce layoffs. Small cracks. Easy to ignore until they aren't. Because once trust starts to slip, everything built on top of it begins to wobble. And that's when the strange part happens. While most assets collapse, a small group doesn't just survive. They double every time. And almost nobody owns them when it matters. Right now, the global economy is sitting in an uncomfortable position. Debt levels are historically high. Interest rates have shifted faster than most systems can adapt. Asset prices, from real estate to equities, are still anchored to assumptions that were built in a very different world. Cheap money, stable growth, endless liquidity. Those assumptions are fading. And whether the next downturn arrives next year or 5 years from now isn't the point. The point is this: when stress hits the system, the same pattern repeats. People rush out of risk. They look for safety. But what they choose is usually wrong. Because what feels safe in normal times often becomes fragile in extreme ones. And what looks boring, outdated, or even pointless quietly becomes the best performing asset in the entire system. To understand why, you have to understand what actually happens during a depression. Not a recession, a depression. In a typical recession, demand slows. Companies cut costs. Governments step in. Central banks lower rates. Eventually, growth returns. It's painful, but manageable. A depression is different. A depression is what happens when the system itself becomes the problem. Too much debt, too much leverage, too many promises that can't be kept at the same time. And when that reality surfaces, everything begins to unwind together. Banks pull back lending. Businesses lose access to credit. Consumers stop spending. Asset prices fall, not because they're worthless, but because nobody has liquidity to buy. It becomes a feedback loop. Falling prices create fear. Fear creates selling. Selling pushes prices even lower. And suddenly, things that seem stable aren't. Real estate becomes illiquid. Stocks collapse. Businesses fail. Not always because they were bad, but because they ran out of time. And in the middle of that chaos, capital begins searching for one thing: certainty. Not growth, not excitement, certainty. That's where the pattern begins. The first asset that consistently doubles during depressions is the one people publicly dismiss the most during good times: gold. Not because it produces income, not because it's innovative, but because it doesn't depend on anyone else's promise. During stable periods, gold looks inefficient. It just sits there. It doesn't generate cash flow. It doesn't scale. So investors ignore it until the system starts shaking. Because when banks look uncertain, when currencies lose purchasing power, when governments expand money supply aggressively, gold stops being unproductive. It becomes neutral ground, a place where counterparty risk disappears. Historically, during periods like the 1930s or the 2008 crisis aftermath, gold didn't just hold value. It surged as confidence in financial systems declined. Not because gold changed, because everything else did. And yet, most investors only move toward it after the move has already started. They wait for confirmation. By then, the doubling phase is already underway. The second asset is even more ironic: cash. But not in the way people think. In normal times, cash feels like a losing strategy. Inflation eats it. Markets outperform it. Holding large amounts of cash looks passive, even foolish, until liquidity disappears. During a depression, cash becomes power. Because everything else is falling, and when prices collapse, cash doesn't need to grow to double in real terms. It simply needs to not fall. Imagine every major asset declining by 50%. Stocks, property, businesses. If you're holding cash, your purchasing power relative to those assets has effectively doubled. You can buy twice as much, twice the land, twice the equity, twice the opportunity. This is the uncomfortable math people ignore. Returns during crises are not just about what goes up. They're about what doesn't go down. But there's a catch. Most people don't hold cash going into a depression because holding cash requires accepting underperformance during good times. And psychologically, that's very hard. So instead, people stay fully invested, right until liquidity becomes the most valuable asset in the system. The third asset hides in plain sight: government bonds, specifically high-quality sovereign debt. During normal conditions, bonds are predictable. Low yield, limited upside, boring. But during a depression, something counterintuitive happens. Interest rates collapse, central banks cut aggressively to stabilize the system. And when rates fall, bond prices rise, sometimes dramatically. Long-duration government bonds can surge as investors flee risk and seek stability. It's not about optimism, it's about preservation. In moments of systemic stress, the market doesn't ask, what can grow? It asks, what will still be there tomorrow? And despite all the long-term debates about government debt, in the short term, strong sovereign bonds often become the default safe haven. Capital floods in, prices rise, and once again, an asset most people ignore during bull markets becomes one of the best performers when things break. The fourth asset is the most misunderstood and the least owned. Productive real assets with pricing power. Not all real estate, not all businesses, specifically assets that generate essential goods or services and can adjust prices as conditions change. Think energy infrastructure, agricultural land, critical supply chains. During a depression, most businesses struggle because demand falls and credit tightens. But essential assets operate under a different dynamic. People still need food, energy, basic materials. These assets don't just survive. They adapt. If currency weakens, they raise prices. If supply tightens, their value increases. Over time, their cash flows and their underlying asset value can expand significantly relative to the rest of the economy. But here's the problem. These assets are difficult to access. They're not always packaged neatly into public markets. They require long-term thinking, operational understanding, patience. So most investors don't own them. Not because they don't work, because they're inconvenient. Now step back and look at the pattern. Gold removes counterparty risk. Cash provides optionality. Government bonds benefit from falling rates. Real assets with pricing power adjust to changing conditions. Four completely different assets, but all connected by one idea. They perform when the system becomes unstable. And that's where the real tension sits. Because during good times, the system feels stable. Risk looks safe, leverage looks smart, growth looks guaranteed. So investors crowd into the same trades. Equities, real estate, speculative assets, the things that worked recently, the things that feel productive. And they ignore the assets designed for when things stop working. It's not a knowledge problem, it's an incentive problem. Holding defensive assets during a bull market feels like failure, until it doesn't. There's another layer most people miss. Timing doesn't save you. Because depressions don't announce themselves clearly. They evolve slowly, then suddenly. By the time it's obvious, repositioning becomes expensive or impossible. Liquidity dries up, spreads widen, opportunities vanish, and the assets that double are already moving. This is why nobody owns them. Not literally nobody, but far fewer people than you'd expect, because owning them requires acting before the need is obvious, and that goes against almost every human instinct. Now here's the uncomfortable question. If these patterns repeat, and they do, why do most portfolios still look the same every cycle? Why are they still concentrated in assets that depend on stability, in a system that periodically becomes unstable? Part of the answer is optimism. Part of it is recency bias. But a large part of it is structural. Modern financial systems reward participation. They reward staying invested. They reward chasing returns. Defensive positioning, by contrast, often comes with short-term underperformance. And in a world measured quarterly, that's hard to justify. So the cycle continues. Assets inflate. Risk builds quietly. And when it breaks, the same small group of assets absorbs the shift. But there's a deeper implication. These four assets don't just perform during depressions. They reveal something about the system itself. That stability is temporary. That liquidity matters more than valuation during stress. That trust, not fundamentals, is often the first thing to disappear. And that the most valuable assets are not always the most exciting ones. They're the ones that function when everything else stops. So the next time you hear, "This time is different," it might be. Every cycle has its own trigger, its own narrative, its own timeline. But the underlying mechanics, they rarely change. The real question isn't whether another downturn will happen. It's whether, when it does, you'll be holding what works, or what worked last time everything felt fine. And by the time that answer becomes obvious, will it all